If you look at a seismograph on, like, a normal, quiet day, it is mostly just this gentle rolling line.
Right, maybe a tiny little tremor here or there.
Yeah, exactly, like a truck driving by or something. But then, completely out of nowhere, the needle just snaps. You get this massive, violent spike on the paper.
The kind of sudden, chaotic movement that makes you spill your coffee and, look around to see if the ground beneath you is actually shifting.
Oh, 100%. And in the financial markets, we just witnessed one of those massive needle-snapping tremors. So, welcome to today's deep dive. We are really glad you're here.
It's a crazy one today.
It really is. To make sense of this, we've pulled together this huge stack of equity research, technical trading charts, and market sentiment reports to figure out exactly what happened to this biotech firm called AbCellera Biologics.
AbCellera, yeah.
Let me tell you, if you are looking at their stock chart right now, it looks exactly like that seismograph going off the charts. We saw this stock gap up over 34% in a single day.
Which is just wild.
Totally wild. It completely shattered its previous 52-week high. It closed at $9.34.
Yeah.
So our mission today is to figure out, whether this company is just riding a fleeting hype cycle or if we are watching the birth of a major biotech powerhouse.
And to really appreciate the scale of this tremor, you have to look at the broader context of the journey the stock has been on.
Right, because it wasn't always up here.
No, not at all. When you dig into the historical technical charts, you see that earlier in the year, this stock was sitting at a 52-week low of roughly $2.75.
Wow. $2.75.
Yeah. So following this recent explosion, it has more than tripled from its absolute bottom.
That's a massive move.
It is, but what is crucial for you as an investor, or just, a curious observer of the biotech space, is that today is all about looking past those flashing green numbers on a screen.
Right, we have to look under the hood.
Exactly. The goal is to understand the fundamental, scientific, and structural shifts happening beneath the surface to drive that kind of insane price action.
So let's start with the trigger, because the stock doesn't just jump 35% because of good vibes, right?
Definitely not.
We need to move from the financial ticker to the underlying science that caused this whole frenzy in the first place.
Yeah.
The documents highlight that the catalyst here was the release of phase 2 clinical trial results for one of their internal drug candidates.
Yeah, the drug is called ABCL 635, and it targets an incredibly common yet historically underserved condition, which is moderate to severe vasomotor symptoms.
Okay, so for those of us outside the medical field, vasomotor symptoms, that's more commonly known as hot flashes, right?
Yeah.
Usually associated with menopause.
They are, yes. And to understand why the market reacted so violently to these phase 2 results, we have to look at the mechanism of how this drug actually works.
Okay, lay it on me.
So ABCL 635 is what is known as an NK3R antagonist.
Okay, 3R.
Right, neurokinin 3 receptor. So during menopause, as estrogen levels drop, the neural pathways in the brain get a bit confused. Specifically, that NK3R receptor becomes overactive. It essentially sends false signals to the body's temperature control center, telling it that it is overheating when it actually isn't.
Oh, wow.
Yeah, and that triggers the massive vasodilation and sweating that we know as a hot flash.
So just so I'm wrapping my head around the mechanism here, if the brain's temperature control center is like a faulty thermostat that keeps turning on the heat, this drug, this antagonist, acts like a roadblock.
Exactly.
Like it physically blocks that faulty signal from ever reaching the thermostat.
That is a perfect way to visualize it. It blocks the receptor, preventing the false signal from firing. And the phase 2 data they released evaluating this mechanism is what analysts in the research reports are actually calling best-in-class efficacy data.
Best in class, really.
Yeah. The trial showed significant, measurable reductions in both the frequency of the hot flashes and the severity of them.
And the sentiment reports also noted that it wasn't just the core symptom that improved, right?
Right, there were secondary benefits.
Yeah, the data showed things like improved sleep quality and a highly favorable tolerability profile.
Yeah.
Which, I mean, when you are dealing with a drug that people might take daily for years, avoiding harsh side effects is just huge for quality of life.
Oh, absolutely.
But the detail in the research that really caught my eye was the dosing. They achieved this level of symptom reduction after just a single dose.
That's the kicker.
Right. Going back to the thermostat analogy, it sounds like finding an instant light switch to turn the heat off rather than just, installing a dimmer and waiting weeks to see if it even helps.
And the market's absorption of that light switch moment is just fascinating to track in the sentiment reports. The net sentiment in the news cycle turned overwhelmingly bullish pretty much overnight.
I bet.
Top financial and medical news outlets were blasting headlines about the significant symptom reduction, and that fueled an almost 19% momentum surge over just a 5-day period, leading into the massive gap up. Investors looked at the raw data and concluded that, hey, not only does the mechanism work, but it appears to work better and faster than existing alternatives.
I have to push back here, though.
Go for it.
Looking at the history of pharmaceutical development, the biotech graveyard is absolutely littered with drugs that looked like flawless miracles in phase 2.
You're not wrong.
Right. Phase 3 trials are notoriously where promising drugs go to die, because suddenly you are testing on thousands of people across vastly more diverse demographics.
Yep, the scale changes everything.
So taking that into consideration, is the market wildly overreacting by adding hundreds of millions of dollars to the company's value based on a relatively small phase 2 trial?
Look, that skepticism is entirely necessary when you're navigating the biotech sector. Phase 3 is absolutely the ultimate gauntlet.
Right.
However, evaluating this through the lens of biotech valuation mechanics, this phase 2 readout represents a massive de-risking event.
De-risking, okay, explain that.
Well, before this data was published, ABCL 635 was largely a scientific hypothesis backed by some early safety data in healthy volunteers.
Sure.
But now it is a proven mechanism functioning successfully within the actual target patient population. The market is aggressively repricing the stock because a significant chunk of the scientific uncertainty has just been removed.
So the investors aren't necessarily saying the drug is guaranteed to reach the pharmacy shelves. They're adjusting the math because the odds of failure just went down significantly.
Exactly. And we also have to factor in the inherent volatility of the stock itself. The technical analysis shows AbCellera has a beta of 1.34.
Okay, and beta measures what exactly?
It measures how a stock moves relative to the overall market. So a beta over 1 indicates high volatility, meaning this stock is naturally prone to wider swings.
Gotcha.
When a highly volatile stock experiences a binary event-driven catalyst, like a clinical trial, succeeding or failing the moves are exponential.
Because everyone rushes to one side of the boat.
Exactly. But the research warns that stocks gapping up this aggressively often face immediate short-term profit taking.
Oh, sure. Traders who bought shares at the $3 bottom are looking at their portfolios, seeing a triple-digit return, and deciding to just cash out.
Right. Take the money and run. So the underlying science is de-risked, but the short-term price action remains highly chaotic.
Okay, so getting a drug through phase 2 is an incredible scientific achievement, but moving it through a massive global phase 3 trial requires an astronomical amount of capital.
Yes, it does.
Which brings us to the company itself.
Right.
Because a successful molecule is only half the story, right? The other half is the business engine actually funding it. And the research points out that AbCellera is not a traditional biotech company.
The structural difference is profound, honestly. A traditional biotech often bets its entire existence on 1 or 2 drug candidates. But AbCellera operates a proprietary antibody discovery platform. Instead of just testing random compounds, they use advanced technology to map and target incredibly complex biological areas, specifically focusing on GPCRs and ion channels.
Let's slow down for a second for those of us who haven't taken a biochemistry class in a decade.
Fair enough.
What does targeting GPCRs and ion channels actually mean, and why is it so important to their business model?
So GPCRs and ion channels are essentially the communication gateways on the surface of human cells. They regulate how cells interact with hormones, neurotransmitters, and outside drugs.
Okay, so they're like the doors to the cell.
Exactly. And they are incredibly important. In fact, a massive percentage of all FDA-approved drugs actually target them.
Really? I didn't know that.
Yeah, but they are notoriously difficult to design antibody drugs for because of their complex three-dimensional shapes. They basically weave in and out of the cell membrane. AbCellera's platform is specifically designed to crack these incredibly difficult targets that legacy pharma companies often struggle with.
So if legacy pharma companies are trying to unlock these complex gateways, AbCellera is basically acting as a highly specialized key cutter.
That's a great way to put it.
And looking at the reports, they leverage this key-cutting technology through a dual business model. On one hand, they have their internal pipeline drugs they own completely, like the hot flash drug we just discussed, plus another one in early phase 1 trials called ABCL 575.
Right. And the other half of their model involves partnering that discovery engine out to the massive legacy pharma giants.
Okay.
The research highlights a recent major collaboration with Vertex Pharmaceuticals. AbCellera is using their platform to discover specific targets for autoimmune diseases on behalf of Vertex.
So they get paid to do the heavy lifting for Vertex.
Exactly. This structure allows them to get paid milestone payments for discovering drugs for other companies while simultaneously advancing their wholly owned internal drugs.
Listening to that structure, it really reminds me of a Hollywood studio model.
Yes.
Well, they are a studio funding a bunch of incredibly expensive indie scripts, which would be their internal research and development.
Yeah.
And they are basically praying one of those scripts becomes a massive billion-dollar box office blockbuster.
Right.
But when you look at the financial reality of running this studio, I mean, the numbers are a little terrifying.
The financial reports certainly paint a stark picture of the cost of innovation. The company posted an impressive year-over-year revenue growth of over 100%.
Which sounds great.
It does. However, they are deeply structurally unprofitable. The equity research highlights a net margin of negative 248%.
Yikes.
Yeah, in the first quarter alone, they posted a net loss of over $43 million.
See, that is the part that stops me in my tracks. Losing almost 2.5 times what you actually bring in revenue would be an absolute death sentence in almost any other sector.
In almost any other sector, yes.
So my immediate question is, with a cash burn rate of over $40 million a quarter, how does a company even survive the years it takes to get a drug through phase 3 and actually commercialize it?
Well, in biotech, the income statement only tells you how fast the ship is burning fuel. The balance sheet tells you how big the fuel tank is. And surprisingly, AbCellera's balance sheet is a massive point of relative strength. The latest quarterly filings show they are sitting on over $560 million in total cash balances and marketable securities.
That's a lot of fuel.
And beyond that, they have secured roughly $110 million in available non-dilutive government funding.
Wait, so combining the cash on hand and the government backing, they have a liquidity war chest of nearly $700 million.
Yep. A nearly $700 million cushion changes the entire operational timeline of the company. It provides a multi-year runway.
That's huge.
It means they can aggressively fund their rising research and development budget, which hit nearly $47 million recently, without facing the constant threat of shareholder dilution.
And dilution is the ultimate boogeyman for biotech investors, right? Because typically, when a small biotech runs out of money, they have to issue millions of new shares to raise cash, which instantly devalues the shares current investors already hold.
Exactly. Having the cash to avoid that is a huge advantage. It allows management to focus entirely on the science rather than constantly pitching Wall Street for survival cash.
Makes sense.
The reports also show they are exercising financial discipline, cutting their general overhead and administrative expenses down from roughly $19 million a year ago to just over $12 million.
Yeah.
So the capital is being deployed into the laboratories, not corner offices.
Okay, having the cash to survive the near term is great, but does the current price tag on the company actually make any logical sense? Because this is where the bear case in the equity research gets really heavy.
It does get heavy.
After this massive 35% pop, the market values AbCellera at nearly $2.9 billion. And their price-to-sales ratio, their PS, is sitting at over 43.
Yeah, a price-to-sales multiple of 43 is a staggering valuation, even when factoring in their triple-digit revenue growth. It indicates that the market cap embeds massive, almost utopian expectations for their future cash flows.
Right, because to put that multiple in perspective for a second, a PS ratio of 43 is like buying a rental house for 43 times the total rent it collects in an entire year.
That's a painful real estate deal.
Exactly. You are paying such a massive premium upfront that it demands absolute flawless perfection from the future just to break even on your investment.
So are investors essentially paying billions today for a pipeline reality that is still years away from actually making any real money?
Honestly, yes. The market is eagerly pricing in the phase 2 de-risking we discussed earlier. Investors see the hot flash drug working in a limited trial, and they are already extrapolating future commercial revenue into today's stock price.
But the bearish analysts argue that the market is entirely failing to discount the immense cost, the extended timeline, and the deep statistical uncertainty of the upcoming phase 3 trials. Furthermore, the vasomotor symptom space is not an empty playing field.
No, not at all. Legacy pharma companies already have established drugs in the women's health sector.
Exactly. AbCellera is a relative newcomer to clinical stage women's health development. The equity research notes a pre-readout analysis that actually characterized AbCellera's stock as a difficult sell.
A difficult sell.
Yeah. And the primary concern highlighted in that analysis is the risk of revenue concentration.
Because that 100% revenue growth isn't coming from, millions of patients buying a daily pill at the pharmacy. It is coming from milestone payments tied to these deal-by-deal partnerships like the one with Vertex.
Right. It is incredibly lumpy revenue.
If the broader biotech funding environment dries up or a partner just decides to pull the plug on a project, that revenue vanishes overnight.
Exactly. The bears argue that generating durable, recurring value beyond sporadic deal economics is incredibly difficult. And the research brings up another layer of risk driving this current price action, which is speculative mechanics.
Oh, right.
The technical report shows symptoms consistent with potential short squeeze dynamics.
The squeeze watch indicators.
Yeah.
So for the listener who might only know about short squeezes from movies about Wall Street, how does that mechanical scramble actually create artificial upward pressure on a stock?
Well, when an investor shorts a stock, they are borrowing shares they don't own and selling them, betting the price will fall so they can buy them back cheaper later.
Right.
If the company suddenly releases highly positive news like best-in-class phase 2 data, the stock price spikes, those short sellers start losing massive amounts of money.
Panic sets in.
A total panic. To stop the bleeding, they are forced to buy shares at the current high market price to return the ones they borrowed. This panicked buying, combined with regular investors trying to get in on the good news, creates a feedback loop that rapidly pushes the price even higher.
So the upward movement isn't entirely based on people believing the company is fundamentally worth $3 billion.
Not entirely, no.
A portion of it is just a mechanical scramble for survival by people who bet against it, which means once that scramble ends, the price could easily deflate back to reality.
It could. Now, the data explicitly notes that confirmed short interest data is unavailable right now, making this speculative.
Fair enough.
However, a stock near a 52-week high breakout, showing a sharp 5-day move on unusually heavy volume, exhibits all the classic symptoms. And high short interest isn't just fuel for a squeeze, it also represents informed institutional players who fundamentally believe the massive valuation is disconnected from the company's reality.
Given this steep valuation, the lumpy revenue model, and the incredibly high stakes of an impending phase 3 trial, what are the actual tangible signals that this company is turning a permanent corner?
There are a few things to watch.
Because there is one piece of data in the sources that absolutely fascinated me, and it has to do with the internal conviction of the people actually running the company.
Ah, yes. The insider trading activity leading up to the data release provides a very compelling counter-narrative to the bear case.
It really does.
Over the past 90 days, the records show a net buying of roughly 660,000 shares across 7 different buy transactions versus only one single sell transaction.
See, there's an old saying in the market. Insiders might sell their company's stock for a dozen different reasons. Maybe they are buying a boat, maybe they have a massive tax bill, or maybe they just want to diversify their portfolio.
Sure.
But they usually only use their own money to buy stock for one single reason. They genuinely believe the price is going to go up.
Yep.
Seeing insiders load up on nearly 660,000 shares right before this data dropped feels like the ultimate put your money where your mouth is moment.
It is a profound signal of internal conviction, no doubt about it. The people who understand the science better than anyone else on Wall Street were willing to risk their own capital on the outcome. But looking past the insider buys and the initial 35% pop, establishing a credible path to long-term recovery requires watching a few critical milestones.
Okay, what are they?
Technically speaking, the immediate signal to monitor is the stock chart. The stock broke through its prior 52-week high of $8.44. The key question over the coming weeks is whether it can sustain its hold above that level on strong trading volume.
So for the technical traders listening, holding above that 844 support level proves this isn't just a fleeting short squeeze, but a permanent repricing by the market.
Exactly.
What about the fundamental business catalysts?
Fundamentally, management has to diversify their clinical risk. A nearly $3 billion valuation riding almost entirely on the success of a single hot flash drug is incredibly precarious.
Yeah, that's putting all your eggs in one basket.
Right. The market needs to see the initiation and a specific trial design for the massive phase 3 study of ABCL 635. A well-designed, globally diversified trial with clear endpoints will solidify their path toward actual commercialization.
Going back to the Hollywood studio analogy, they need to prove they have more than one good script in the pipeline to justify the studio's massive valuation.
Precisely, which is why the upcoming top-line data for their other drug candidate, ABCL 575, which is currently in phase 1 trials, is so crucial.
Ah, okay.
Validating a second, entirely different drug from their proprietary platform proves their discovery engine is replicable, not just a one-hit wonder.
That makes total sense.
Furthermore, securing new large-scale partnership deals would provide necessary non-dilutive funding and offer external validation from legacy pharma that their GPCR and ion channel technology is truly world-class.
Well, as we wrap up this deep dive, it becomes pretty clear that AbCellera is defined by a fascinating duality.
It really is.
On one side of the scale, they possess undeniable, scientifically validated momentum. They just delivered best-in-class phase 2 data for a widespread condition. Insiders are buying shares hand over fist, and they are sitting on a remarkably comfortable $700 million cash runway that protects them from immediate dilution.
But the gravity pulling on the other side of that scale is equally powerful.
Oh, absolutely.
You have deep systemic unprofitability, a sky-high price-to-sales multiple that demands absolute perfection, the notoriously grueling and expensive road of phase 3 clinical trials ahead, and the persistent structural risk of relying on unpredictable partnership milestone payments.
It really reinforces the idea that being well-informed in the biotech sector isn't just about reading the flashy headline trial results and chasing a stock that jumps 35%.
No, it's never that simple.
It is a constant balancing act. You have to measure the sheer brilliance of the clinical science against the cold, hard realities of financial cash burn and sky-high market expectations. Science happens in a pristine lab, but valuation is dictated by the ruthless mechanics of the market.
Very well said.
Thanks. This leaves us with a final provocative thought for you to ponder on your own. If an advanced antibody discovery platform like AbCellera actually pulls this off, if they successfully transition from just being the hired guns discovering targets for big partners to developing, owning, and commercializing their own blockbuster drugs, how will that fundamentally disrupt the traditional power dynamics of the healthcare industry?
It's a huge question.
Because if the agile biotech startups writing the indie script suddenly build their own massive distribution networks, the entire industry's seismograph is going to snap. Thanks for joining us on this deep dive. Keep your eyes on the needle.